So up until now, we have seen external economies of scale. Now start looking at internal economies of scale. So internal economies of scale are peculiar to a firm. External economies of scale were peculiar to industry. So here what happens is that as the firm is producing more output, its average cost is falling, right? So it has certain benefits which accrue to a firm. Uh, One thing is that it is going to lead to a market structure which is an imperfect market structure. Uh, we have seen that difference also in the first class of external economies of scale, where we have differentiated between external economies and internal economies, and we have said this that in case of internal economies of scale, it is going to lead to a market structure which is imperfect competition, right? What happens in imperfect competition? First thing is that there will be small number of firms. So imperfect competition is geared more towards efficiency. So only those firms are going to survive which are more efficient, right? So there'll be small number of firms market is going to support. And the other thing is that these firms, they know that they have a certain degree of control over the prices, right? They have a certain degree of control over the prices. They can control the price. They're not the price takers. And thirdly, they also know this that they will be able to supply more if they're going to reduce the price, right? So their customer base is going to increase in case if they're going to reduce the price. So let me just write few points for you. One, in case of imperfect competition, firms produce goods that are differentiated, right? So there'll be few firms in the market and they'll be producing differentiated goods. So they are not producing homogeneous goods as in the case of the perfect competition. They are telling that although on the face of it our products they look similar, but we have a better quality than our competitor. And because they are giving this perception in the mind of the consumer, they can charge the little higher price than the cost, which a perfectly competitive producer cannot. So they have a certain degree of influence over the price. Uh, then there are few firms. There'll be few firms which will be supported in the market, and these few firms they have an influence on prices. They have an influence on prices, right? Another thing is that production is concentrated more towards the better performing firms. So most of the market is actually going towards those firms which are performing better. So there'll be already few firms will be supported by the market, right? So they have the influence on the prices, they're not the price takers. So let us assume that the demand function for a particular firm is given by Q is equal to S into 1 upon N minus B into P minus P bar. S is the total output of the industry. P is the price which I am charging. I am that firm. Let's say you and some other people are my competitors, and the average price which is charged by my competitors is P bar, right? N is the number of firms in the industry. So I will be able to sell more if S is higher, del Q by del S is positive, right? If the total industry output is higher, I will be able to sell more. If the market is expanding, total output in the industry is more, I will be able to sell more. Or I will be able to sell more if my competitors are going to charge, if the average price which is charged by my competitors is more than what I am charging, right? Uh, So higher the price charged by the rival firms, more I will be able to sell, right? This is also logical. You can also write del Q by del P bar. That will also come out to be positive. Fair enough. What is B? B is the responsiveness of firm sales to its price. So how my sales are going to be affected if my price is going to change. That is B is. That is what B is. We are assuming that the industry output is unaffected by P bar. One thing. That is whatever the average price of the rival firms is. That is not affecting the industry output. That is unaffected by that. And all the firms, they are symmetric. That is, they have the same, they're facing the same demand function and they have the same cost function. They're facing the same demand function and the same cost function, right? If the number of firms are more, I will be able to sell less. This is also logical. Uh, if n is more, I will be able to sell less. That is also there. Okay. And if I am going to charge a high price, again, I'm going to sell less. If my competitors on an average are going to charge more than what I am charging, I'll be able to sell more. But if I'm charging more, I will be able to sell less, right? If everyone is charging the same price, I am also charging the same price and I'm charging the average price of what others are charging, then in that case, everyone will have the same share in the market, right? So the point is that if P is equal to P bar, the price which I am charging is equal to the average price of all of the firms, then in that case, the share the of the demand is S upon N, total output upon the number of firms. So everyone will have the same market share, right? Uh, so they will be able to sell S by N units of the output, right? Uh, this is one thing. This is also true. That is, if I am charging more than what you are charging, I will be able to sell less. If you are charging more than what I am charging, you will be able to sell less. That is logical, right? So this is about the assumptions. Now let us look at how equilibrium is going to come in this market. Now we need to determine the equilibrium number of firms and what is the equilibrium P bar, which is going to be charged. That is the average price charged by competitors. For that, we are going to use two curves. One is the CC curve and another is PP curve. CC curve is the upward sloping relationship between the number of firms and average cost. Now, what is this? Right? So, just think about it this way. Let me just write here about the CC curve first. If there are more firms, right, in the market, then each firm is going to produce less output because that total output is going to be distributed among all the firms. Lower is the output which is going to be produced by each firm. What is AC? F upon Q plus small c. So if Q is less because the number of firms are more, if Q is less, then this is going to affect that AC is going to be more. Huh? So just write this: more firms there are, lower is the output, of each firm, right? And higher is the AC of each firm, and higher is the AC of each firm. This is true, right? Okay. Now all firms are symmetric. If all firms are symmetric, they are charging the same price. Since all firms are symmetric, they will charge the same price. P is equal to P bar. If P is equal to P bar, then what is Q? Q was what? I think S into 1 upon N minus B, P minus P bar. Huh? If P is equal to P bar, then Q is equal to S by N. That is also true. Hmm? Then Q is equal to S by N, right? Okay, what is AC? Is F upon Q plus small c. Yes. Okay. Can I also write in place of Q, can I write S by N? I can. Plus C. So that is small c N F by S, right? So that is what AC is. So AC is small c plus NF by S plus NF by S. If there are more firms in the industry, average cost is going to be higher, right? Because the output which each firm is producing, that is less. If there are more firms in the industry, N is more, then AC is also going to be higher for each firm, right? This is going to generate the upward sloping curve. This is going to generate the upward sloping curve. So here I'm going to write the number of firms. Here I'm going to write P, C, P bar, whatever you want to write. And this is what my CC curve is. This is what my CC curve is. Yeah. Now let us talk about PP curve. Now let us talk about PP curve. PP curve is the downward sloping relationship between N and P bar. Right? N and P. So what happens here? I am charging price P and there are number of firms N. If there are more firms in the market, I will be charging lesser price if I want to sell more. That is the only thing I'll be doing. Right. The more intense is the competition, in order to cut down the other person, I will be charging a lesser price. That is there, right? So more firms. So I've written about the PP curve there. Just write the explanation also. It is downward sloping. I mean, PP curve is also drawn in your NNP space, right? It is downward sloping. It is downward sloping. Because more firms there are, More intense is the competition. More intense is the competition among the firms. And lower is the price they charge. And lower is the price they charge. So I can write Q is equal to your S by N plus SBP bar minus SP. You can write SBP minus SBP. Huh? But this is nothing. You started with this now. You started with this function 1 upon n minus b into p minus p bar. You started with this, you just opened this up. So Q is equal to S by N plus SBP bar minus SBP. That's it. Well, if you look at it, if I write it in this way, so this is my constant term. S is constant, N is constant, B is constant, and this is what my term with P. So don't you think that it is somewhat like this? Q is equal to A minus BP curve. है ना? This is somewhat like this. Q is equal to A minus BP curve. This is what my constant is, and this is there. Okay. Okay. So I can write everything in terms of P. I can write that. So let me just write S BP equals to S by N plus SBP bar minus K. So P is equal to 1 upon SB I need to find out the MR. So that is the reason I'm multiplying all this. I'm sorry, this recording has gone a little lengthier. And MR would be, just differentiate this TR with respect to Q. 1 upon SB, S upon N plus SBP bar minus 2SB Q minus 2SB Q. I can write it like this. I can write it like this. Okay. Can I also write it like this? 1 upon Bn plus P bar minus 2SBQ. This is what my MR is. Yeah. This is what my MR is. Well, we have already shown above that Q by S is equal to 1 by N. That's what you have shown. Q by S is equal to 1 by N. You remember now, if P is equal to P bar. You've shown it above, right? So can I write here in place of this Q by S, I can write 1 upon N. So it is 1 upon Bn plus P bar minus 2 upon B into 1 upon N. That's what it is, because Q by S is 1 upon N. And then I can also write, so I can write this as 1 upon Bn, sorry, in fact, minus 1 upon Bn, 1 upon Bn minus 2 upon Bn plus P bar. But P bar is equal to P. So this is what my MR is. This is what my MR is. So at equilibrium, MR equals to MC. What is MR? Minus 1 upon Bn plus P bar. But P bar is equal to P. MC is what? C. So if I want to write P minus C, that is equal to 1 upon Bn. Right? That is equal to 1 upon Bn. So if the number of firms is going to increase, this markup is going to fall. That's there. If the number of firms are going to increase, this markup is going to fall. More firms are there in the industry, or you can also write it like this if you want. P is equal to 1 upon Bn plus C. So if number of firms are increasing, this price is going to fall. More firms there are, in industry, lower the price. Each firm will charge, right? And the reason is also this, that this is the markup now. They're able to get lesser markup. If the number of firms are going to increase, the markup is what? That how far you can set the price above the cost. So this markup is going to decrease as the number of firms is going to increase, right? So the relationship between N and P, this is negative. That's what it is. This is what my PP curve is. This is what my PP curve is. And where they are intersecting, that is giving me the equilibrium number of firms N and the equilibrium price P. Equilibrium number of firms N and equilibrium price P, right? So we'll take the discussion further, that how does trade takes place in this model, and then we will also talk about what are the responses of the firms to the trade, who are going to gain and who is going to lose under internal economies of scale, right? Thank you, beta.